We're going to start our Forex education here with this first video where we're going to define three terms. And these are three very important terms. This is the language of the Forex here. So we're going to understand what is a pip, what is the base when you're talking about a currency pair, and what is the quote when you're talking about a currency pair. So what's the quote currency, what's the base currency, and what's a pip? And we can actually explain this quite easily by looking at a specific exchange rate and using a little real-life case example. Let's say, for example, that we were evaluating the Greater British Pound against the US dollar. So we have the pound versus the dollar. We can make a lot of sense out of this by looking at an example. So let's say, for example, that you lived in the US and you were going to take an extended vacation to the UK. So you're going to the UK for the spring, and as you travel, you're taking with you $500 worth of spending cash. All right? Now you land in London, you're going to need to exchange this currency for the domestic currency so you can spend it. Now what you're going to get quoted to you is an exchange rate. So how much are these $500 worth in pounds? If you convert these into pounds, how many do you get? And the calculation uses an exchange rate, which in this case, the exchange rate today, in fact, is 1.40. Now it doesn't just stop at 1.40. So in other words, this exchange rate right here is 1.40, meaning $1.40 per pound. But actually, Forex traders take this out an extra 2 decimal places. So we go all the way out to 1.4061 is the current exchange rate. So now, this is an easy calculation. If a pound costs $1.4061, then how many pounds are we going to get? Well, we're going to get about 355 pounds. So pretty easy to understand, right? Let's say we stay in London for a couple of months and subsequently we're on our way out the door, but we haven't spent any of that spending cash. We use credit cards the whole time or traveler's checks or whatever. And so we still have these 355 pounds in our pocket. And wouldn't you know it, but the dollar has actually declined in value. The dollar has actually gotten weaker while we've been on our vacation. Sounds bad, right? In fact, the current exchange rate right now is as we're heading out the door, is 1.5061. So it's actually changed quite a bit. It's $1.50 per pound. Sounds bad, right? I mean, the dollar's gotten weaker. But in fact, actually, this has turned out pretty good. Because now, if the exchange rate, we've been holding pounds, and if the exchange rate is 1.5061, we're going to get back $533. So we just profited $33 on our vacation. But what caused this? Essentially what happened was we were holding pounds, which was an asset, just like holding stocks or bonds or whatever it is. And that asset improved in value versus the dollar. You can see that through the exchange rate. It has become more expensive for someone with dollars to buy pounds. This asset has become more valuable, just like holding a stock would. So we've actually profited here, and this is essentially what Forex traders are doing every day. Except on a much larger scale and usually more frequently. Most Forex traders are trading more often than a couple of times a year, and of course we don't have to do our exchanges in hard currency. You don't need to go to the airport and actually trade this currency. So in this example, we've actually defined all three of these terms that we set out as our initial goal. A pip is this decimal place right here. So if this decimal place actually went to 1.5062, we would say that the exchange rate has improved by 1 pip. If it were to go to 1.5060, the exchange rate has changed down, or it's declined by 1 pip. That's what that means. So in this case, we actually saw an improvement of 1,000 pips. You can see here we got 4 decimal places. We went from 4061 to 5061. It's actually improved by 1,000 pips. This is what you will hear Forex traders talk about as they talk about changes to the price of an exchange rate. We've also talked about what's the base currency. The base currency is this one right over here. It's the one on the left-hand side of this little exchange rate equation. So the pound is the base currency. We also know what the quote currency is because it's the other one. It's the dollar. And you can see these actually shown on charts. So for example, if the pound is improving in value against the dollar, it's like a little seesaw where the pound is now going to weight that base currency is getting stronger. It's going to weight that currency exchange rate, and that chart is going to be headed up, as you can see here. So if the base currency, the one on the left-hand side, is heavier and it's pushing that seesaw up, then we'll see the market trending up. Conversely, if the quote currency, or the dollar in this case, which is, you'll notice where it gets its name, quote, because we just quoted the exchange rate in dollar terms. That's why it's called the quote currency. If it's improving in value, then we'll see the chart of that exchange rate declining, going down. This is one of the fundamental differences we find with traders who are moving from, let's say, the equity market or the bond market or something like that to currencies, where being bearish or looking to short a currency pair has a somewhat negative connotation. So shorting stocks is somewhat negative. Shorting bonds is somewhat negative, depending on as far as that asset class goes. But in the currency market, shorting a currency pair or being long a currency pair, it really has no negative or positive connotation. What you're essentially doing is you're saying, if you're long a currency pair, you think the base is going to get stronger than the quote currency. If you are short a currency pair, you think the quote currency is going to become stronger than the base currency. Those are the kinds of estimates that you're making. Now, in the article, you're going to learn about that the pound dollar belongs to a series of currency pairs that are called the majors. There's also the crosses. They're different than the majors, but they work the same way. And there's even the exotics, so currencies that are traded much less frequently. A great exercise to internalize this information is to pull up some currency charts and look at them to say, all right, the base currency is getting stronger than the quote because it's uptrending. So which one is the base currency? So which one's getting stronger? If the chart is downtrending, you can say, well, the quote currency is clearly getting stronger. Which one's the quote? So this currency is getting stronger relative to this one, and try to explain it to someone else. Teaching this information is really going to help you internalize it, so you can start to paper trade this a little bit and make some estimates as to, well, I think the dollar is going to get stronger, or I think the euro is going to get stronger, or the Swiss franc, or the pound, or what have you. Therefore, I know which direction I think that chart is going to go in the future.